Last week marked the end of a record year for the major markets. At Tuesday's close, the NASDAQ reported an incredible 35.23% return, followed by a 28.88% gain in the S&P 500 and a 22.34% return in the Dow Jones. For the S&P 500, this marks the sixth best return for the index. This is quite a feat considering that the index had fallen 20% within 3 months' time by Christmas Eve of 2018. The recovery that began after Christmas of 2018 was sharp as it led into 2019. In fact, 27% of the overall gains for last year took place within January alone. After a strong first quarter, mid-year volatility in May caused losses in the market that just about took away the gains that had been made in January. As the market neared the end of the year, the S&P 500 managed to record 4 consecutive months of gains. At the sector level, the advances that have been seen in the NASDAQ were even greater in the S&P 500 technology sector, as it beat all others with a remarkable gain of 48%. In fact, all sectors, aside from energy, closed with double-digit returns. Last year was another year in which diversification in assets outside of large cap, especially large cap growth, might cause an investor to feel like they underperformed. Yet the double-digit returns were a welcome sight in the smaller cap and value segments of the market. They just were not as great as the gains seen in the blue chip stocks that often made the news. Even bonds fared well in 2019. The Bloomberg Barclays U.S. Aggregate Bond Index recorded an incredible 8.72% return for last year. Likewise, Treasuries began the year with a 10-year trading at 2.69%, only to see it close 2019 at 1.92%. This week marks the first full trading week of the year. Investors will now be looking forward to see how the new year compares with the last.